Well, welcome everybody. Thank you for joining us today. Today we have two very special guests with us. We have Beth Thompson, who is the branch manager with Wallick and Volk out of Kirkland. Hello, Beth.
Hello, good afternoon.
Good. How are you doing?
I'm doing great. How are you doing?
Good, good, good. Thank you for joining us.
Thank you.
Yeah, and then we also have a very special guest that you were able to secure for us. So would you please introduce Mr. Brian?
Yes, this is Brian Rogerson. He's the president of our company, and so I'm very honored and I'm thankful for him to, make a presence with us today and answer some of the bigger questions that are affecting us as a country and the industry overall. So everybody meet Brian Rogerson.
Well, thanks for having me. I look forward to talking to you guys.
Thank you, Brian. Yeah, I was talking to Beth and I said, hey, we got to get out in front of people, and then there's some questions that everybody's asking, and then we need somebody to answer those. And then she said, yeah, give me a week and I'll get back to you. And then a week later, she's like, hey, you want to get our president on this? I'm like, what? So that was really nice of you. Thank you for coming.
My pleasure.
So I will start on with a question that I have is with all this COVID-19 that's happening, what is the effect of that on the mortgage industry?
Well, the first effect is basically whether people are gainfully employed, at the time they actually fund. So, people were entering into contracts and then, becoming furloughed or, cut hours, cut compensation or whatever. So the original effect was whether the loan could even fund or not in the first place. So, that became the first challenge. The second challenge became the constricting of the capital and the qualifications for people that may have been pre-qualified under a certain debt ratio or a certain program. And, 3 weeks later, that program's just disappeared. So the biggest hits have come in the form of gainful employment. And the second biggest hit would be in the products that are available today versus, 2 months ago.
Got it. Got it. So, as these, all the different lenders are tightening up all the restrictions, right? I mean, why are they doing it now? And then why were they loose in the first place?
Well, I would actually say they weren't loose based on, industry low levels of default and even the non-QM, the non-qualified mortgage, the guy that owns a pizza restaurant, but he gets his loan based on bank statements versus tax returns. Well, typical self-employed borrower takes some liberty when filing their tax returns, but the pizza place is doing quite well. He's clearly qualified. He's putting a large down payment down. So they mitigated the risk by, larger down payments and FICO requirements and all that other stuff. So I don't think we could declassify where we were at as loose, but I can say that I think what we've seen is an overcorrection. I think that, instantly shutting off someone that puts 30% down on a property doesn't make any sense. Why? Is 30% down not 30% down anymore? They're not going to lose that type of an investment into a property, provided their business can still run. So if it's a pizza place, for example, and they're shut down for 2 months, well, then maybe the pizza place doesn't get the non-QM loan for the next, couple of months until they're back in business. But there were plenty of other businesses that continued on. So why should those people be punished? So, we throw everything into one basket and then we start over correcting. And next thing you know, like jumbo borrowers, why did a jumbo borrower all of a sudden not become eligible for financing when he still has his job at General Motors and he still has $400,000 in the bank and $2 million in his 401k? So I think there was a lot of overcorrection. And that's why we're seeing it shift back already as quickly as we are. Things are already coming back into the market that disappeared just 3 weeks ago, and now they're showing back up. So I think that it was an overcorrection, to be honest with you.
Mm-hmm.
Oh, that's good. Yeah. So Beth, are you seeing anything on the local level there that you were having trouble in getting people approved, or people who were approved and then something changed right during the course of the approval, and now like it's all up in the air, or are you guys seeing that it's being closed, or what's going on there?
Yeah, absolutely. I mean, it goes back to first and foremost the unemployment issue. We have, all of these applicants, that are approved, and now they don't have a job. So you can't do anything, right? So that put a lot of people on hold for purchasing. As you know, I think we've had some clients who had to deal with that.
Yeah.
And also the situation with the change in FICO score requirements. So some of our first-time home buyers, that maybe don't have the credit established or maybe don't have the scores they need, all of a sudden now we're put in a situation where we don't even have a product to put them in. And so what we saw, it was like all of a sudden out of the blue, we have these products just being cut and we're like, oh gosh, what are we going to do? How are we going to handle this? They just went away really quick, just like Brian was saying. It was like this reaction of, oh my gosh, forbearance, oh my gosh, employment, like all these things happen at once. And then we're stuck with all these buyers confused, just like we were. We were confused that first week. We were going, what's next? We don't know what to expect. Are we back to 2008? Everybody's closing their doors. What's going to happen? It kind of that sense of, being scared and a little bit of insecurity of just like, what's going to be your next steps? But what I've seen actually, I'd say over the last month is the employment issue is not changing. That's still going to be required. You have to have a job to be able to pay bills, right? But we have seen some of the products have lightened up. Some of them have gotten a little bit harder. Even like the state bond programs, which we get a lot of our first-time home buyers, they just came out with it this morning. Actually, they've changed the requirements for credit scores, and they're not going to be serviced by a certain servicer. So they're making changes to tighten up. So I see some of the higher risk buyers are not going to be getting the financing until they get the scores back or until they're back to those types of things. So overall, those are going to be the two biggest things I think that I've seen just on a local level and my team, what they've been experiencing. And the third would be high balance and jumbo, just like Brian talked about. So that's been really difficult as well because that's a big part of our market, especially living in King County. We see a lot of that product in that price range. So absolutely. But like Brian had said as well, we do expect we're seeing some of it come back, but it's just not as fast as we wanted to. Obviously, I think that's, as a nation, we're not coming back as fast as we want to be coming back. So I don't think it's, it's definitely nothing, the sky's not. I can definitely say that.
No, that's great to hear. Yeah. Yes, Brian.
I think,
Sorry.
I think that, it's a company to company decision as well. So for example, when this all started happening, we could have followed suit and stopped refinancing, stop offering bond loans, down payment assistance, first time home buyers. We could have been frozen by fear. And, the big thing was forbearance and servicing, right? All they talked about is how the services are all going to go out of business. Well, Wallick and Volk, we service loans and we have service capacity for the agency and for Ginnie Mae. We ran into servicing while everyone was running out. And as a result, we've had 2 record-breaking months for a company that's been around since 1932. We've had 2 record-breaking months during this pandemic. Now, in part, it's because we're not operating out of fear, we're operating out of confidence. And I think our decision to have done such is already proving out because the market is coming back to us. So we would normally sell loans in the secondary. We're like, hey, there's no appetite to sell the loans. Doesn't mean we can't still put these people that qualify into mortgages and just service them, which is completely contradictory to what everyone else was saying to do. But that's usually how you know it's right? If everyone's running out of something, you probably want to run into it because everybody is usually wrong, right? I always say that in Vegas, they put marble to the ceiling every 3 years in these casinos for a reason, because most people lose money, not make money, right? So if everyone's doing one thing, common wisdom for me is I'm going to do the opposite. And we've done that. And we've been able to provide a lot of financing for people like in your marketplace that would otherwise have had difficult time in these last 60 days. And the benefit of doing such is that it looks like it's drifting back to normality. So we're very comfortable with that decision that we made. And even the bond authorities, we got on the phone with the bond authorities and we're like, you're like state entities that are designed to help put people into housing. Like that, to not do that would be the end of real estate. Why would we create our own mess? And they're like, we're fully confident that we're not going anywhere. And we're like, we still offered bond loans. We never stopped doing it. we don't make overlays either, which is we don't make up our own rules. So if FHA says 620, we'll stay to 620. We're not like adding things ourselves, and we're just operating from that perspective. And I think that people like Beth and all the people in her offices, they're reaping the rewards of that confidence right now because we are the stable lender in the marketplace at this time.
Yeah, no, I hear you. And then I think the trend I hear is there's fear of something going to happen, right? Which has not yet happened, and which is like driving the markets into uncertainty, right? Oh my God, the roof is gonna fall out, but I don't even see a crack yet. You know what I mean? So there's a lot of that. So another question that comes out of this: how are times now different than 2008?
Yeah, well, 2008 was a completely different animal. So 2008 was based on people acquiring property that probably didn't qualify to acquire property on a speculation of values continuing to rise at the pace that they were rising, right? So, it's a totally different animal. Now you have to qualify to buy. I went into the mortgage business in 1987. That was what they taught me. Look, it's common sense. If they qualify, they can buy. In 2008, you didn't have to qualify. And, people hid behind the subprime crisis as victims. But, to be quite honest with you, most people that took a subprime loan and signed a document that said their mortgage payment was $6,000 a month. I mean, come on, you're intelligent enough to know that if you have to make a payment for $6,000 a month, you have to have the resources and the capacity to make that payment. And they all want to cry like they were victims. But, what they were speculators that got caught with a market that went stagnant. And then when it went stagnant, it collapsed because all of that paper flooded back into neighborhoods, and that diminished the value. We're not seeing that in the state of Texas. I have a daughter that's moving to Arlington for her husband's residency as a medical doctor, and she has for 3 weeks been one of 5 to 10 offers on every property she has made an offer on. Now, a little bit different than Kirkland or Seattle, where it's a $1.8 million home versus a $275, but nonetheless that market is still vibrant. So, but they're full of qualified buyers that can afford that payment trying to acquire that property. And even in your marketplace, we're not putting people into homes that don't qualify. Even the non-QM is a qualified borrower, just using a different approach to determine the full qualifications and such. So I don't think there's any comparison, to be honest with you.
Okay, no, thank you for that. And then I have a question from Billy. She said, can't really hear Beth. Billy, let us know if you still can. We want to make sure that you're able to hear everybody. And then if you guys have any questions, please put them in the chat box, and I can moderate them as they come in. So, what are you guys' thoughts on interest rates going forward? You think they're going to go up? They're going to go down? We saw a little dip. I think it was a month and a half, 2 months ago, and then they came back up. Now seems like they're stable. Where do you think where it's going, and how's the mortgage industry reacting to it?
Well, the rates are low, and they're near historic low. My personal belief is that there's probably room for them to go a little bit lower over time. So circumstantially, you have to make a decision. If you're a refinance client, is it in my best interest to do it now? And is there enough net benefit? For which, to be honest with you, there's a ton of net benefit. That's why you're seeing the volume that we're seeing. On the purchase side of the equation, if you're buying at 3.25 or 2.75, they're relatively the same. So where I think is the interest rates are going to have to go is they're going to have to stay low while we prop up this economy again. And I think, we're going to be looking at a period of maybe almost a year of that type of climate, especially since we've got to find employment for, 10% unemployment roughly, that their businesses have collapsed, and now they need to be retooled, retrained, or reapplied into another company that, they're not currently working for. So I think we're going to have to prop up the economy using real estate, and real estate's like 40% of the GDP. So I think that we're going to be part of the long-term plan to correct the results of this pandemic. And that's the other thing with 2008. 2008 was a history of greed and bad decisions coming to a head. 2020 is some crazy virus comes in and overnight shocks the entire world, right? So they're totally different events. One was self-inflicted, and this one's not self-inflicted. Now we have to react to what's the best long-term solution for the pandemic. But that was a completely different animal. So the answer to your question for rates is I think they're going to stay low, and I think they're going to stay low at least for a year, in my opinion.
No, that's great to hear, right? Because a lot of people are like, oh yeah, they're gonna drop, the market's gonna drop, and then everything's gonna go crazy, and that's when we're gonna buy. So this gives them a little confidence. No, it's not going anywhere, right? Because like we talked about it before, it's the fear. People are just like, something's gonna happen, and we don't know when it's gonna happen, right? So we've seen a lot of dips in the stock market as we, with all this stuff, like going all the way down and then going all the way up. How is real estate and mortgages related to stock market? Like if it drops, right? Let's say it's dropped and then it stays low for a few days. Does that affect, mortgage industry or not?
Go ahead, Beth.
I mean, Brian's going to give a better answer than me, of course. Absolutely, yes, absolutely, it's going to affect it. I think a lot of it too is people. I think it comes back to fear as well. I think people start to panic a little bit, so then we start seeing changes in the market. I think it's a big part of what we're seeing. Would you agree with me, Brian? I think it's
yeah. The direct correlation is that if the stock market drops, so then people are afraid, so out of fear, they buy bonds, which are the stabilized but very low yield alternative, right? So then they rush into bonds and then rates move the wrong way. If the market goes up and stocks seem like a great idea, the bonds don't sell, so that they drop in value when rates go down. So there's a definite connection. But it's not always dollar for dollar. And actually that's where this whole pandemic has affected our marketplace. So in the month of March, when this all hit, all the stuff that we had closed and we had sitting on our warehouse lines and had hedged and use all these sophisticated, items, the value of the loans that we actually closed diminished by about 100 basis points. So in English, when we did $153 million worth of loans, we lost $1.5 million in gross receipts to the pandemic overnight. We quickly made the right adjustments and survived that and went into servicing, which will recover some of that over time. So it's all a matter of how you handle this. If you doubled down on your losses and got out and ran scared, you've actually lost more money. If you did the opposite and trusted that it was going to be okay, you're going to benefit from it from a profit standpoint, and that's where we've gone. But where you see the stock market really fluctuate, it's in the consumer confidence, right? So then the stock market affects, the value of the dollar. Should I buy a house? Should I rent? All this other stuff, along with all the so-called experts that tell you to rent for your entire life, and somehow that's a brilliant idea. I don't understand it, because I use an example of 2008. If I owned a property in 2008 that went down in value by $300,000 and I strategically defaulted and just walked away, I own zero, right? If I had held on to that property, I would have already been in a positive equity position by now, and I would have been out of that travesty. Well, if I own Enron stock and Enron stock goes to zero, what does it ever become worth? Zero. When has real estate ever gone to zero and stayed there? So to me, real estate investing is a much safer long-term plan for every investor to own some of their portfolio should always be in real estate. Because last time I checked, I've never been able to buy a property for zero. I could buy Enron stock for zero today. So I'm not a big stock market guy. I believe the stock market is legalized gambling, and I believe real estate is investing.
Yeah, that's
great. And my 401k tells me that today as well, by the way.
Yeah, how much has that grown over a period of time, and how much your real estate investment has grown over a period of time, right?
Yeah, like my last 60 days has been a 20% reduction in the 401k value, but my home in Gold Canyon has gone up. So I don't know.
Yeah. Yeah, it's a constant battle. So I just want to know from a client perspective, how are things different in the lending industry on a national level versus on a local level, right? So things that happens up, in the entire country, right? How does that affect you as a bank or as a lender, and how does that affect a client at a local level?
So when the national picture goes the way it has, is with New York and New Jersey and all these heavy populated states on the East Coast, and then combine LA, right, in that area, and the amount of concentration, they adjust products basically on a national level. So when jumbo goes away overnight, it goes away nationally, as opposed to jumbo saying, well, in Texas and Arizona and Washington, we're not seeing any of this. Why don't we keep it there? It's the lender just shuts it off across the board. So I think that's really where the national hit is affecting us, right? Because they're scared in so many heavily populated marketplaces, Chicago, New Jersey, New York, none of which is our footprint. We're only out west. So we've been fortunate from, our particular footprint not to suffer from being an East Coast lender. Also, back east is a different animal because they're judicial foreclosure state. You need a judge to remove somebody from a home in Massachusetts. I hear of clients in Massachusetts staying in their house 8 years without making a payment. Imagine the instability of your marketplace if someone could buy a house and stay in it for 8 years without making a mortgage payment. So, we're our worst enemy at times because of, again, overreaction. There should be geographical assessments that go into this, and that's how we've survived. Because as a servicer, Fannie Mae and Freddie Mac and Ginnie Mae, they haven't really changed anything during this. So all that's changed is whether you have the nerve or not to be a player and to service those loans. And because we've made those decisions, we've been able to negate a lot of what's constricted. Now, jumbo and some of the other stuff, a different animal, but we still have jumbo product. We're still closing jumbo loans. The difference is that borderline qualified jumbo borrower will have a more difficult time today than they did 3 months ago. But in a couple of months, they'll probably be back to normal.
Yeah. No, thank you. We have a question here from Jennifer. She said, how can we prepare our clients for tighter restrictions and inform them, not alarm them? As a real estate professional, I want to help educate, yet not jump into the lender sandbox and misinform.
Yeah. So obviously, we always prefer to have the conversation about financing. It's really hard when the agent wants to start educating on product lines and what's happening on rates and things like that. I mean, we've had this conversation where, it's always better to let me have that conversation so that they're actually talking to somebody who does this on the daily. We are working with the changes. We do get the notifications. I mean, our company over informs us of what's going on. So we are way ahead of the game. I mean, I hear it all the time, agents coming back saying, I'm so glad that you know what's going on, because we work with so many loan officers that have no clue what's going on. And so that's something that our company does a really good job. Thankfully, Brian does a really good job of getting us up to speed of what's happening, what's changing, so we know what's happening. I don't think you should, I don't think there's anything that you should say that should scare your client. I think that it would be more of a conversation of just saying, let me have you talk with their advisor that can actually, instruct you on what changes may have happened or may have not happened. Because, the real estate agent's typically not going to understand all the different product lines and the different changes that take place. Sometimes, there's been times when it feels like daily, right? Especially, a month ago. It's just always smart. I mean, it goes back to doing that initial pre-approval to make sure that we have the conversation with them and they understand that due to the current market that we're in, or the current COVID situation or whatever it is, these are additional things we have to take place, that are required for qualification. So I don't think it's a thing where you need to scare your borrowers and make them think they don't get finance. If the borrowers, sometimes we have borrowers say, well, my credit's really bad. And you say, okay, we'll contact my mortgage advisor that I work with, explain these things to you. And then we're able to instruct them, because a lot of times it's not bad for you. So it's kind of one of those fine lines, because I know you guys want to be educated, and I try to educate whenever I get information or hear product changes or something, I'm trying to keep you guys up to speed of be aware of this, because I don't want you surprised when we're in contract and I say, oh yeah, well, he doesn't have a job anymore, so we no longer can do this loan, or we have to hold off 30 days or whatever it is. You know, so that's, I mean, that's really on us to make sure that we keep you guys up to speed on, you know, especially if it's drastic changes. Minor stuff, you don't really need to know, but you know, when it's the things that are happening, you need to be aware of it, for sure.
Yeah, no, thank you. Yeah, Jennifer, if you still need clarification, let us know. But I think that misinformation travels faster than accurate information. And sometimes your client calls you first and you're like, what? I didn't hear any of that. So it's like you got to backtrack that, like, hold on, let me verify that before you jump to a conclusion, right? And for me, some of my clients, you know, they don't speak English. So I need to, you know, you and I had a conversation multiple times, right? Like, tell me how this works so I can take it to them, right? And still let them know that I am not the professional, right? I'm not the lender. I'm not going to make a final decision, right? It's going to be the lender. So we want to make sure it's coming from you and we're sending it to them directly. Otherwise, we will be in a position that nobody's going to like, right? We don't want to make any promises that eventually you say, hey, no, we can't do that. And they're going to say, you said this, and now it looks bad on everybody's part, right?
Yeah, we have 300 employees plus, and every day I get an email that says, I heard Freddie Mac is not doing investment properties anymore. And I'm like, well, where did you hear that from? Well, my sister went to the bank and the bank said that they're not doing it anymore. That's correct. The bank is not, Freddie Mac is. So so what happens is that all it takes is for someone, we have a major competitor that's got thousands and thousands of loan officers. And I won't use them by name, although I almost always throw it out there, but I'm gonna skip saying their name.
You can email me, Brian.
They immediately ended bond lending the second this happened, and they restricted their refinances to 700 FICO scores or higher. And that went out to the marketplace like it was gospel, and it was what they decided to do. We spent days educating people that didn't actually happen. And to your point on your pre-qualified borrowers, the difference in our platform, and Beth lives by this methodology, and this is why they have so much success, is we don't take anyone's word for how their circumstances are and then issue you a pre-qualification letter in hopes that what they said actually turns into that reality. We gather all those documents. So it might take her 2 or 3 more days to issue that pre-qualification letter, but that pre-qualification letter it's actually real. And we compete in an industry where you just have to have a phone conversation with most of the loan officers, and they'll issue a $750,000 pre-approval letter, and they've never even seen an income document. So, you know, really understanding up front and educating the client on, now more than ever, you've got to give them your tax returns. You've got to give them the pay stubs. You've got to give them that. Why do they need my 401k statement? I'm not going to take money out of my 401k. No, they're going to build their case around the fact that you've got 2 years worth of payments and reserves on that 401k. All of these factors, like it used to be old school before people hit enter to get a mortgage, these are all factors that have returned to the marketplace, and that's how we operate. So we get that full picture. We don't have to worry about that borrower. Now, the guy that's at 50% debt to income ratio, we'll have a conversation with them. Look, you're at a high debt to income ratio. If they shift this thing at all, we're going to have to back down what you're pre-qualified for. But to the opposite side of the equation, Beth might have a conversation with a guy that's got a 20% debt to income ratio. And we can say to him with certainty, look, don't worry about what you're hearing about debt to income ratios. Your ratio is so low, they're never going to drop it to that level. They might drop to 43, but they're not dropping to 23. So you're safe. And so that's why it's so personalized, the service. And the trusted advisor is not across the board. It's your specific qualifications as it applies to you based on what you do for a living and all these other factors. And that's where people get lost, because they want to put everything into one box, and it's not all in one box. Your circumstances are your exact circumstances, and our plan is built on you, not an industry-wide opportunity, but what is your specific circumstances and what do we see for you, even with these changes, and how it could affect you. And in most cases, people are not affected by the changes. The ones that are living on the edges we have to have a different conversation with them because they may be subject to some change.
Yeah, no, thank you. That clarifies a lot. You know, some people, we just got to get ready, right? We're not there yet. And then let's see what we can do to get you across that line so that we're all ready and set to go, right? We don't want to issue a pre-approval letter per se. And then, 8 days, 10 days into the contract, we're like, oh, we can't do anything now, right? That looks bad on part. So it's nice to know that we're doing everything on the front end so that we know that this is going to go through. Right. So some of the things that a lot of people are talking about, either they lost their job or, they're laid out for some time or they're furloughed, is forbearance. Right. And everybody's talking about it. And then, everybody on social media is an expert in lending right now. And then, even any topic you pick. So how does it affect a borrower, right, on their credit? And how can it what's the word I'm trying to use, refrain from them, like a year down the road or 2 years down the road, to either refi or get a new loan?
Yeah, so I mean, for sure, forbearance is misunderstood because, not to get political, one party in particular wanted everyone to take the free government cheese with no regards for how it might hurt them in the long run. So forbearance hurts the consumer in the standpoint that it does not affect their FICO score, and that is correct, and it does not get reported as a derogatory item on their credit report, and that is correct. So if you tell half the story, everyone should forbear and take a mortgage vacation for the next 6 to 12 months because everything's going to be great. But what it does affect is how the mortgage industry can operate moving forward, lending to people, the liquidity crisis that this would cause all the servicers, because what they don't tell you is if you forbear your payments, Wallick and Volk, if we're servicing your loan, we make your payments on your behalf. So the people that bought these securities, they get paid no matter what. So they're, the trade-off of that lower yield is guaranteed payment. So if the borrower doesn't pay, we pay. But now back to the consumer. If you go into forbearance, you cannot obtain a new mortgage unless that loan is current and you are out of forbearance. So if you add those payments to a repayment plan, say over 18 to 24 months, you could be 2 years away from ever qualifying again. God forbid the servicer let you add those 6 payments to the end of the loan. So in theory, you're never current. So you will always stay in mortgage purgatory, so to speak, because you're not current. So therefore, you technically don't qualify for a new mortgage, and you would have to find a way to get those 6 payments made, get reported as current and out of forbearance in order to qualify. Now that's as it stands today. We are a very forgiving society, so we don't know if like 6 months from now, if they decide, you know what, we're gonna give everyone a get out of jail free card because, this didn't really happen because of them, this happened to them. And the logical way for all these servicers to get those payments all at one time is in a refinance where they get those 8 payments paid to them instantly. So there is some possibility that the rules will change, but I wouldn't count on it because you can only go by with what we're dealing with today. So I'm a proponent of forbearance if you've lost your job and this is how you keep your family in a home and this is how you get by for now. And you know what? If that's the case, you really shouldn't be thinking about buying second homes or investment properties or even refinancing. You're just trying to, deal with today's reality. And that person 100% deserves a forbearance and they will get that. It's the ones that are choosing to do it, they're going to pay the price because they made a decision based on misinformation, and that misinformation is going to cost them opportunity.
Yeah, no, that's great. Beth,
can you hear me?
Yep. Yes.
So also, I know it's come up, the mortgage rating as well, because all of our agencies require a 12-month mortgage history. And so, last I heard was it's not decided exactly how that's going to play out. And so now you put yourself in a situation as well where you don't have a 12-month mortgage history. So you want to refinance 6 months from now? Well, sorry. So I don't know. I haven't heard anything different. Have you, Brian?
No, it's still it's still, you need a 12-month history with no lates, and a loan that's not actually being paid is neither late nor paid. So therefore it doesn't fit the category of 12 months payments with no lates. So even if someone does go into forbearance and they allow down the road for them to refinance, I think they're 12 months of payments away from refinancing or buying another home.
Yeah, yeah. That's something that people got to understand. If you're in a position to pay your mortgage, right? You don't want to be in a position that a year later you're like, hey, I want to either upgrade or downsize or something, and now you can't do it because of a decision you made 6 months ago. So
and the 2008 comparison fits into here as well, because if you really look at 2008, yes, there was a very small group of people that speculated and just couldn't make payments. And had they gone into default or foreclosure, it would have been not that big of a hit. But it was all the neighbors that saw them not paying their mortgage and just walking away that they strategically defaulted. And all the strategic default actually led to the collapse of the real estate prices and the mortgage industry in that time. Well, it's the strategic forbearer that's going to do the same thing. So if you strategically forbear just because you want a mortgage vacation, you're going to pay the piper, and we're all going to pay the price too, because it could back up in the form of value. It could, stop appreciation or even, create some backwards momentum in real estate value for a short period of time until that all gets worked out. So it's the people that are doing it out of choice and not necessity is who we need to speak to. That's who we're educating. We're not trying to talk the guy out of it that's out of necessity. We're 100% supporting that person do that for his family. It's the person that does it out of choice that needs to stop doing it, because they're going to affect everybody long-term, including themselves.
Yeah, no, and then I don't remember the correct numbers, but I heard that the request for forbearance shot through the roof, when this whole thing was happening. And what I could all think of was, if you now has a 6 months of forbearance, you cannot pay after 6 months for those 7 months total, right? And, are we going to see a lot of short sales? Are we going to see a lot of foreclosures? Is that trend coming back, right? And how is it going to affect the industry? Because at the end of the day, it's going to affect everybody, right? So
yeah, because we're forbearing on loans that had minimal or no down payment. So without the values moving quickly, to keep up with them not making payments, the rubber hits the road at some place. And I think that that's a great point. I mean, the long-term effect of this is yet to be known. I think that there could be some stagnation. I think value is going to hold. I just don't know that it'll go up as fast. So it still makes it a great time to purchase when you got such industry low rates. And you could see that an economy that's going to kind of rebuild itself, you want to get on the front side of that, right? Because it's going to be a little bit different from what it looks like 2 years from now.
Exactly. So does it differ on if I got a conventional loan or FHA loan or a VA loan? And where does my PMI comes into all this? I mean, I'm paying for that mortgage insurance. So if I'm taking forbearance, can I tap into that? How does that work? Or
yeah. So the private mortgage insurance is really insurance for the lender to be made whole to 80% loan to value. So when someone gets PMI, it just simply means that we might have lent them 97%, but we have insurance on the gap between 80 and 97. So it's got nothing to do with the consumer or their ability to tap into anything from a payment standpoint. With regards to the servicing side, the only difference is where is the money coming from and how long do you have to make payments on behalf of the client. But making payments on behalf of the client is, catastrophic. I mean, there's not that type of profit margin in lending that we can afford to make payments, including taxes and insurance, by the way, for every, all these consumers. In fact, our industry varies differently in one regard, and I'll run through this real quick, but we have real estate agents in Arizona that are showing clients properties and advertising that you get to buy this house and go 6 months without a payment. They're selling it they're like selling mattresses, right? You're not selling mattresses. They're basically encouraging their clients to buy a home and then immediately request forbearance and live in a home for 6 months without payment. So, that's the last thing you should be doing as an industry. Now, to the other side of our equation, as a lender, if we give you a loan and you go into forbearance immediately, we have to pay back every dollar that was generated in the producing of that loan. So that would be the equivalent of you guys for the next 6 months. Every house you sell, if they decide to forbear, you have to give back your entire real estate commission.
Yeah.
Or imagine in the real estate industry, if the real estate agent for the next year and this is our world every day, for the next year that these people are in the business of owning that home, if they decide to sell the home or stop making payments, you have to return all your commissions, because that's what we have to do as a lender every single year.
Yeah,
So it's a completely different dynamic.
That's the hard truth behind it too, right? It's like the lender borrowed the money or sell the securities to somebody, and you still got to make those payments.
Correct.
Right. And then for you, and then I can't even think of what those realtors are thinking of, telling people, let's buy you a house and then don't worry about 6 months payments because of this, right? But at the end of those 6 months is when the real book is going to open and say, hey, now you owe 7 months of total payments. What you going to do? Right? Are you going to pay it all together now, or are we going to build it back into the loan? Right? So I don't think they're going to like that realtor in the long run. It's not good for everybody. So I know you touched on how Wallick and Volk has taken steps when this whole thing has happened. But I want to also know how you are ensuring that, what steps are you taking as we move forward, right? How are you staying ahead of the game?
So we're continuing to pay attention to, are the people that we've already done this with actually entering into forbearance? Are people looking for workouts so that we can calculate moving forward how aggressive of a stance we can take? And we have been fortunate in that it's not happening with any type of industry level numbers. So we're very aggressive, to be honest with you. We've been around since 1932. Jim Volk's father was, of Wallick and Volk from all the way back in 1932. I mean, they were lending in the Depression. They've been involved with buying out the pension program of the Wyoming state employees and getting people back their pension through real estate vehicles. And when interest rates were 18 and they were lending at 15, they were actually using the pension funds from the state of Wyoming, which gave the state of Wyoming employees guaranteed funds on there. So there's a lot of ways we think outside the box. Now, we're specifically designed to stay relatively small because we're not a market share company. So if you don't have to rely on market share to be profitable and exist, but you have to create your niche and relationship like Beth has built with you and others, that's who we are. So we run really contradictory to the marketplace because we don't have 24,000 loan officers I have to keep in mind when we're deciding whether we're going to service these loans or not. We have 105 in 8 states producing, the volume that we produce. We're much like a law firm than we are a mortgage banking firm. Beth's a partner in the firm. So we're making decisions on the benefit of our partners, and you're her partner. So to us, it's that type of footprint. We've only got to deal in a small percentage of society when you look at us in the whole. So we're able to operate really contradictory to marketplace. And right now, that's never been more apparent because we're doing things that others are like, you're crazy, you shouldn't be doing that. Well, that's where we differ because we see it as an opportunity and you see it as a fire. We're running into the opportunity, you're trying to run away from the fire. Well, it's like the whole quarantine. How long can you hide?
Yeah.
You hide indefinitely. So we could have hid and been like everybody else, or we could have ran into the fire, which we did. And our offices have dealt with COVID-19. We've had some employees that, have tested positive, and we've taken the proper precautions. We sent everyone home for 2 weeks. We waited till they were cleared. And then we made it that you could work remote or you could work in the office. We're not mandating anything. And we're finding that even through this process, people that we never thought could work at home are actually just as productive. So we're learning a lot about people in this process, and we're going to become a better lender because of it, just because we're not operating out of fear, and we're willing to realize that you don't have to have every person sitting in office to succeed. And if they do their work, okay, it doesn't matter where they sit. As long as we know they're getting it done and your clients are closing on time and we're supporting our partners the way we support them, that's who we are.
No, that's great, and then it's great to know the history of the lender that's been through a lot of stuff. I mean, so many things have happened since that time, right? And then so you have that experience in order to move forward and then make decisions, right? So, guys, if you have any questions, put them in the chat box. And I want to turn the gears a little bit, as we, when we started, we quickly ran into the mortgage industry and what's happening. But I kind of also really want to know Brian on a personal level and Beth on a personal level, right? So who is Brian, right? Let's dive into that, and then we can go to Beth, so we can go know a little bit more about you.
Okay. Well, I have a wife and 4 children, and all 3 of my daughters are married. And my oldest daughter has my little guy Ryder, who's 2, and she's got baby number 2, who we just found out is another boy last night, due in September. My next daughter has a baby, and he's a 1-year-old, and her husband's the resident doctor moving to Arlington. My daughter Hope runs an online business and lives in LA, although she's hiding in Gold Canyon, Arizona as we speak, since LA's on lockdown. Her husband's actually in the film industry, so there's not much going on in that industry as we speak, but he positioned himself for the crisis that we're in now. My youngest son, my only son, just graduated from college, and he's actually going to come to work for us and learn the business from the ground up. He interviewed in San Diego for a job on the other side of the equation, the money side of the equation, and hedge funds and all that stuff. And he saw what they make and decided he'd be more like his dad instead. So I'm a family man. My kids and my family are everything. I work to provide them the lifestyle that we all afford, but I love what I do. I get up every single day since I've been in this business. I don't look at it like, oh, I've got to go to the office. I look at it like I'm blessed to be able to go to an office, especially in times like this where there's so many people that, can't, provide for their families, or they're not sure they're even going to have a job again. We're very blessed in real estate and mortgage right now to have our lives really inconvenience is at best what we're dealing with, right? Other people's lives are changing for a long time to come. And we've been at best inconvenienced. So, that's kind of who I am. And I'm a tough guy from Massachusetts, but I would do anything for anybody, and don't tell anybody that so they don't take advantage of me. So, Miss Beth?
Very true. So yeah, I obviously I have 3 daughters. I'm not married, but my 2 oldest are gone. They've moved out. One's living in Dallas, which I'm not quite sure how I feel about it, but she loves it. So she's down there. She works in the service industry down there, and they're closed. She worked at one of the steakhouses there. So she hasn't worked. She's been on vacation. She's having fun. And so I have another daughter that lives in Seattle, and then I have one left at home. So I'm almost an empty nester. My youngest is a freshman in high school, and so I have my last few years with her, and then I don't know what I'm going to do with myself.
Yeah, we're gonna have to keep you busy. That's what it is.
Please do. Yes. No. I love what I do as well. I couldn't imagine not doing it. I've been in the industry not as long as Brian. He is a little bit older than me, and since 1997 is when I first got into it as an assistant, and from there I owned a mortgage company here in Seattle for almost 10 years, and then I've been with different companies managing and things like that. So I love the growth piece of it, and I love the support piece of it. So that's a big side for me, and I love creating the teams and that kind of thing. And I also love producing. I love problem solving. I love figuring out the files are also different, the situations are also different, so it keeps it exciting every single day. I never know, especially with your clients, I never know what I'm going to get.
Yeah. Yeah, I know we've had the conversations. Where are you getting these guys from? So.
So here is.
The baby.
Oh my God, it's cute.
So that's Ryder in Denver.
It's so cute.
So I'm looking at helping to raise up the next generation. Being a grandfather is actually way cooler than being a father for all the selfish reasons. All I get to do is play with them, right? It's all play and then hand them back, right? So I play with them all the time, and then I hand them back to their parents.
Yep. That's awesome. So you borrow the kid, and when they're happy, and then when they're about to turn over, you just put them back. Like, here you go, take
Yeah,
it.
exactly. Yeah.
So one question I have is like, how do you stay focused, in times like this? Because I know I've gone almost insane, like staying at home. So just like, how do you stay and focus, and then keep on your task and keep on your dreams?
I would say for me, it's knowing that there's just so many people that are counting on us. And if we can do our part, I have a saying that if everybody that could help somebody did help somebody, there'd be nobody left to help. And, it's a very simple formula because there's way more people that don't need help than do. So it could easily work, but, mankind is selfish, so it doesn't. But, I look at it like I have an obligation to the 300 families of employees that work here to create stability and to lead them through this darkness, so to speak. And if we can spread that out exponentially through our partnership with people like yourself and your agents, I mean, how many families can we create this positive, we're going to get through this, don't listen to everything that you hear, don't immediately assume that they're telling you the truth. You think about this logically. Have we ever shut down the country for the flu? But no, we haven't. And I'm not minimizing death because death is part of life and life is fragile. But there is no way to run and hide. And I'm just trying to be that voice of reason. And even this whole COVID-19 approach, right? When they said everyone go home so we can protect the healthcare industry, and you guys were one of the first places to get hit from that from a healthcare perspective, right? Everyone go home. We need to protect the healthcare industry so that we don't have a run on the healthcare industry and we can flatten the curve. And I'm like, everyone needs to do that. I'm down with that. Well, when the healthcare industry starts to collapse because they're laying people off as a result of the plan, that's no longer a plan. So why haven't we stopped the madness? There's more to this. I mean, if the people we're trying to protect are the same people we now put out of work, that's not a plan, nor did we protect them. So, I'm very skeptical about how we're handling it from that standpoint. Collapsing the U.S. economy so that, politically there could be some gain, if that's part of it, man, that's pretty ugly that we're willing to do that. But even if it's not part of it, collapsing the economy so we can accomplish nothing makes no sense, because if people are going to get sick, they're going to get sick. We haven't stopped cancer this way. Have we all stayed in our house so no one catches cancer? I mean, we've been fighting cancer since forever, and it still exists. So what made this so different? And why is the healthcare industry only interested in COVID-19? I mean, are there no people that, had that little spot that if they had gotten checked out would have been fine? And now they're not going to be fine because they're not getting the attention that I just think that we're not thinking about this logically. And I look at it, I could do my part with at least the 300 families I control by being the voice of reason, the voice of stability. Let my words be action, which is don't worry about it. Tell your clients are going to close. We had a COVID-19 issue happen right away with one of Beth's transactions on a high balance FHA loan that every other company would not have funded. We funded it blind in anticipation of figuring it out, and we did. But other companies would have ran and just simply not funded. So I can only control what I can control, but it's a pretty big sphere when you take it out by all of you guys as well. If every one of our people have 10 people connected to it, we're touching 3,000 families, not 300. So if everyone would do their part, we could all get this through this together. But everyone wants to throw shots at each other, and that's not the solution. This is not a political statement. I'm saying humanity needs to step up and realize, hey, are we thinking this thing through? Are we hurting more people than we're helping? Because if we are, that's not a solution either. So
yeah. No, I appreciate that, and I know that's I can totally relate to that. Beth, what about you?
Yeah, and I mean, obviously a lot of similar to what Brian's saying, but at the same time too, it's been so much, every day has been such a requirement of education. I mean, like, it's like every single morning I have to start my day with making sure I'm up to speed of what's going on, right? So it actually has not felt like I've had any downtime at all. It's actually felt like I've had less time because I'm working more. So, I mean, that's the reality. It's like, I just feel like now, obviously, and people expect us to be available 24/7 because they're like, oh, well, they're working from home, so we could reach them any time of the day, you know, and so that piece has totally changed. But, you know, we've been so extremely busy that it hasn't been a thing of like, how am I getting through this and how am I getting through my day to day? It's like, I need 10 more hours in my day because there's so much in my day right now. It's definitely been, you know, and obviously my staff, my team, everybody's had way more questions, and I mean, we've just had a lot more situations to deal with too. So I'm involved in a lot more files as well. Same with Brian. You know, it's like, I mean, you know, and I have to reach out to him sometimes because I'm like, I don't know how to answer this. Like, there's just a lot of, it's just been kind of a crazy couple months. But yeah, so it hasn't been, you know, overall for me, I don't think it's been a negative thing. Other than the sense it's been really hard watching the families that have been affected. That's been the hardest piece of it, because really we've still just been really busy, you know, doing our thing. You know, it's been, I think it's been an advantage in the sense that we've been able to also support and educate a lot of agents that weren't getting that support, or that they were working with people that don't provide any of that education, or that they were working with loan officers that just got, you know, all on the refi bandwagon because it was like free money. And so they just stopped paying attention to real estate agents, which I know you guys have all seen that too on your side. You know, so I mean, it's been, I mean, it's probably as bad that it may sound, it's kind of been a positive thing for me in that sense, because it's been, you know, it's kind of cleaned it up a little bit on that side of it too, to where some of my competition probably will go away, and that's great. That's always, you know, positive for us, you know. So yeah, so it's, I don't see it as being a survival thing for me.
Oh, that's great. That's great. Yeah. So last few minutes here, and then I want to find out, Brian, if people want to reach out to you and then get in touch with you, how can they do that?
My email is Brian.Rogerson, Rogerson, at wvmb.com, WilliamVictorMortgageBank.com. And my cell is 480-236-8287. Glad to speak to anyone, anytime. I mean, I'm very hands-on. Not sitting in some ivory tower. This is a, you know, a small entity by size, and I know every loan officer by name. I know, you know, their children. We know their spouses, their significant others. It's that type of atmosphere. So if anyone's got any questions or want to dig deeper into something, I'd be glad to speak to them.
Thank you. Thank you. And what about you, Beth?
Yep. So same email, Beth.Thompson, THOMPSON @WBMB.com. And then my cell number is 509-998-9343. And same, anybody can reach out anytime, text, call, email, either.
Thank you. Thank you. I really, really appreciate your guys' time, and especially Brian's, who, you know, came out, you know, and spoke to us, and then gave us your words of wisdom, and then really, really appreciate that. And then Beth, once again, thank you. I asked, you know, a few minutes of your time, and you brought the president of the company, so that was really, really awesome. So thank you, guys. I really appreciate your time, and hopefully we'll talk sometime soon.
Thank you.
Thank you.
Thank you.
Take care.
Brian.
Bye.